Forex trading strategies for beginners that they should know. Millions of people have entered the market in the United States alone this year, and brokers are fighting for their confidence and money. Because of this rivalry, now is an excellent opportunity to begin trading rapidly and at a lower cost than ever before. Most brokerages will provide you with a trading platform for free. The most crucial thing is that you have a burning desire to make money with Forex. However, having a strong plan is equally important, since not having one is like pouring your money into a well and hoping for the rewards to start coming in. To make it easier to choose a strategy, we've compiled a list of the most common trading strategies, categorizing them according to how long they take to implement and how dangerous they are. Some are highly beginner-friendly and may earn you your first profits right away, while others will take more time to master but can offer you sheer delight and monetary wealth once you figure them out. Let's look at a few effective Forex techniques and discover which one is best for you. What exactly is Forex? Forex is an abbreviation for foreign exchange, and it refers to the worldwide currency market. Traders from all over the globe may buy and sell currencies here using their computers, making gains day after day by forecasting what will happen in the markets. Knowing how to forecast whether prices will rise or fall is essential for becoming a successful trader. Understanding charts, interpreting them, and paying attention to key world events are all part of learning how to trade Forex. You do not need to know everything if you wish to concentrate in one field. You simply need a startup cash and a reliable Forex broker to invest in if you have the appropriate expertise. When all of that is taken care of, the final piece of the puzzle is deciding on a viable plan. Exchanging currency involves recognizing and rapidly seizing minor opportunities. The making of these forecasts is a rather frequent, easy procedure and is generally based on simple mathematics. You don't have to be a mathematician. Most kinds of Forex trade are quite straightforward to become acclimated to, and trade techniques are introduced. With a basic technique, you can forecast correctly and profit most of the time until a black swan event is involved. The finest tactics will work in the foreseeable future. We will explain various techniques and evaluate how easy to start, time and risky each person is. You will hopefully be motivated and may even begin to make money shortly. 1. Trend trading. This technique utilizes price patterns to discover chances for purchasing and selling. The lower lows in the price chart and the highest ones are also to be seen here. You should then draw lines over them, representing the trend in prices. This might be either a tendency up or down. For inexperienced traders, the advantages of this technique are extremely reachable, and there are always many trade chances and a solid risk and reward ratio. 2. Range trading. This method involves looking at a price chart and locating the so-called lines of resistance and support. By looking for the highest price points within a particular period and connecting them with a straight line, you may create a resistance line. The line of resistance is the customary maximum price. It's all a bubble, and that means you should sell, as you're not going to obtain a higher price soon. You can see a resistance line as a currency pair's upper price limit. That implies that traders have overbooked and that the price will fall very quickly if the price goes beyond that. The support line is exactly the opposite of the resistance line. You take all of the spots on the chart where the price fell and pull a straight line. When the price falls below this line, the traders have overvendors and it's time to purchase your currencies at an affordable price. These are strong benefits when the price is relatively stagnant, works best in a low volatility market, and a safe, startup method, which takes minimum research resources. 3. Forex scalping. Scalping Forex indicates for people who don't know that you may get tiny businesses quickly and make little profit of each one. Scalpers manually or using a trading algorithm, which uses your instructions, open and close many positions every day to determine when to sell or buy. Scalping is as timely and profitable as you like. Individual transactions are normally opened and shut down within a few minutes, but you may do as many as you like during the day. First, you need to recognize a trend like you do when trading in trends. Make sure price hikes are increasing and price drops are rising. This approach applies to nearly every financial item. 4. Position trading. This approach involves fundamentals, but also macroeconomic trends and pertinent information. This strategy is of long-term importance. The aim is for a long time to determine pricing and to use it to assess if prices in a foreseeable future will rise or fall. In order to operate on this technique, you need a long time or even years to look at price charts and keep your position long whether the price falls or when the price flies. It's a patient trader game, and this strategy may be used for currency and inventories. The benefits are quite beneficial, ideal for long-term traders and working on the stock market also. Their value is very positive. 5. Carry trade. This indicates that one currency is borrowed at a cheap rate and then invested in another currency with a higher rate. This will lead to a favorable development of the commerce. There are two aspects to the profitability of your transaction: the interest rate differential between the two currencies that you exchange and the quantity of your capital or borrowing power. This indicates that earnings might not only be modest but also significant. It depends on everything. Risk is always involved. Because transportation typically involves leverage, it is likely to be extremely hazardous. To make a profitable transaction, you must consider interest rate changes over a medium to long time period. Ideally, you should borrow a currency with a low, decreasing interest rate and exchange it for one with a high, growing one. As a result, your profits will be as high as they can be. The benefits of this approach include an average risk-reward ratio, a lack of time commitment, and the potential for very significant returns if the perfect chance arises. 6. Day trading. Day trading is unsuitable for you if you wish to invest sporadically. However, if you want to make Forex your full-time career, this may be the method for you. Day traders open and close all of their positions on the same trading day. Nothing is left to sit overnight. This approach is all on detecting minor daily price swings, buying cheap, and selling high. Trades are completed in a matter of hours, if not minutes, and it is rare to achieve a significant return on a single one. A few transactions every day, on the other hand, will start to add up if you execute them correctly. You will acquire enough cash to make every deal worthwhile. The sort of goods you select to trade will decide how dangerous this is, but generally you will face modest price adjustments, so that if you trade badly your balance will not lose a lot. Because the risk-reward ratio is acceptable, leveraging your bets becomes more appealing. This approach has several advantages, including a high risk-reward ratio and a large number of trading chances. 7. 50 pips a day. If you desire a new and popular approach with a definite daily cash target, this is the plan for you. It is the Forex strategy of 50 pips each day. Traders enter two opposing positions with pending orders after the candlestick closes. When one order is triggered by a price change, the other order is instantly cancelled. There's no way to go wrong this way. Your target is 50 pips, and your stop-loss order is often placed between 5 and 10 pips. After you've completed all of your preparations, it's time to sit back and allow price fluctuations take care of the rest. The bar after the candlestick where you put your order should ideally be as high or as low as feasible. However, even if it isn't, you may cancel your purchases and control risk in this manner. Our method has the lowest risk and takes the least amount of time on this list. 8. Swing trading. This is a mid to short-term trading strategy that entails predicting market changes and buying or selling accordingly. Swing trading is similar to trend and range trading, except that swing traders examine price patterns in a short time frame and close deals within a few hours or days. Because swing trading is a short-term technique, traders must concentrate solely on price research rather than long-term macroeconomic patterns and major global happenings. Swing trading becomes easier as a result, but it also becomes more dangerous because price fluctuations are constantly more erratic on a daily basis. This technique has an average risk-reward ratio and requires little time. Conclusion. One of the most risky kinds of trading is Forex. This may, however, be avoided by employing a variety of techniques. Each of the above techniques has its own set of benefits. Neither is superior. Everyone is best suited to their chosen strategy. At the very least, by employing this approach, You novices will have a better understanding of the judgments you make in Forex trading, allowing you to maximize your profits.